This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Stop me if you've heard this before. The S&P closes at an all-time high. Its 50th record close in the past 12 months. What's driving it, and which sectors should you invest in for the long haul?
Good for your health? Think your employer will offer health plans 10 years from now? Well, you might want to think again.
What's your broker hiding? A personal bankruptcy, criminal charges? And is a Wall Street regulator routinely deleting key information about the person you're trusting with your money? All that and more tonight on Nightly Business Report for Thursday, March 6th. Good evening, everybody. I'm Sue Herrera in for Susie Garrett, who has the evening off.
And I'm Tyler Matheson. Welcome, everyone. Well, it was another record-setting day on Wall Street, with investors getting a boost from some good news about jobs. Just one day ahead of the February jobs report, probably the best measure of economic growth and stability, first-time jobless claims tumbled by 26,000 last week. They fell to a three-month low. And an outplacement firm reported that planned corporate layoffs declined by 24% from February of last year. Not even a dip in factory orders last month or a slowdown in fourth quarter worker productivity could really derail today's rally, at least not much today. On Wall Street, the Dow finished 61 points higher. The Nasdaq did stumble slightly after spending much of the day in the black. It ended down 5 points, and the S&P 500 edged just 3 points higher today, but that was enough to end the session at a fresh all-time closing high of 1877.
All right, joining us now to talk more about the markets is Kate Warren. She's investment strategist at Edward Jones. Good to see you, Kate. Welcome back.
Thank you.
Let's start, first of all, with what you're expecting in the jobs report tomorrow. Where is your number, and specifically what in the report is going to be the most important for you?
Well, we're certainly looking for a total job creation of around 145,000 and the unemployment rate to stay at 6.6%. But the things we're really going to be watching, in addition to that headline number, which I think will be what everybody is watching, are what happens to part-time workers, what happens to wages, with the idea being it's the details that are also giving us some comfort that the economy is continuing to improve, even though the headline number the last couple of months has been pretty weak.
You know, Kate, there are always plenty of things to worry about, whether it's the economy or the unemployment number or the Ukraine or emerging markets or whatever. But what is your outlook for the U.S. stock market in 2014, and what would you be advising investors to do?
Well, our outlook is pretty positive. We think volatility will increase so that we'll see more fluctuations, but we think the trend is higher because we do think the economy is improving, although not dramatically, just somewhat. We think earnings will continue to rise in mid-single digits, and we think the global economy is improving as well. That synchronized global rebound actually will give a boost to U.S. markets, so we think stocks will move higher. That means that we think investors should be adding stocks if they need to in their portfolio. But the most important thing to do right now is to be sure you've got the right mix of stocks and bonds. If you had the right mix a year ago today, after a 30% rise in U.S. stocks, you may actually need to be adding fixed income, even though we think stocks will continue to go higher and are good investments today.
Are there specific stocks that you think might be still a very good value in this market?
Yes, we think that investors need to be a little more selective, and that a good place to look are companies that are benefiting from the stronger economic growth. In that, we'd be looking at companies in the technology area, in industrials, and we'd be looking at companies and in energy, and we'd be looking at companies specifically like Devon or EMC, companies that basically are going to benefit from that stronger growth.
Let's talk a little bit about the global situation right now. How do you filter into your outlook what's going on in Ukraine and the particular issues that have been confronting several of the emerging markets, whether it's Turkey, Brazil, or others?
Well, certainly to start more broadly with emerging markets in general, many countries have specific problems. They have large current account deficits, they're importing more than they're exporting, they have budget deficits, and they have falling currencies, partly due to the fact that China's growth has slowed, and in many cases, they're commodity producers and they're selling less. So we think that across the board, emerging markets look pretty risky, and we'd be keeping those to less than 5% of your portfolio. Ukraine in particular is sort of a different issue because it's really been a concern because people are worried that we'll see a military escalation. We don't think that's likely to occur, but it could certainly roil markets again, and that's what we saw Monday. We think that's calmed down a lot and is probably going to stay calm, even though the politics are unstable, and we don't really know what's going to happen diplomatically or even where there could turn into a military situation again.
Kate Warren, thank you. Before we let you go, any disclosures about the stocks that you mentioned to us?
I have a family member that owns EMC.
All right. Thank you, Kate. Good to see you again.
Thank you. Nice to see you again.
Investment strategist over at Edward Jones.
Well, one important member of the Fed is sounding upbeat about the economy and the central bank's tapering plans. Federal Reserve of New York President William Dudley says the threshold to change the current reduction plans for the Fed's bond-buying stimulus measures is, quote, pretty high. Dudley says that for the Fed to deviate from the steady pace of cutting its bond purchases, economic conditions would have to change in a big way.
Do you feel any richer? The Federal Reserve reports that thanks to soaring home prices and the surging stock market, household net worth rose to a record high last year. The collective net worth of U.S. households shot up another $3 trillion in the final quarter of 2013 to a total of nearly $81 trillion.
A pair of big-name retailers out with disappointing earnings last quarter. Profits fell 15% at the warehouse chain Costco after it slashed prices on food to be competitive with Walmart and Target. And the office supply giant Staples missed earnings forecast, too, after sales tumbled 10%. Now the chain plans to save $500 million a year by shutting 225 stores. That's 1/10 of its footprint. Shares of Staples got, well, let's call it pinned today, while Costco shares were down about 3%.
Well, although Nike may be the most recognized name in athletic footwear and apparel in the world, it's fighting off some tough competition from Under Armour, Lululemon, and others as it makes a big push ahead of the World Cup soccer tournament, which is taking place in Brazil. It starts in just 3 months. So how does the company hope to outrun the competition? Sarah Eisen spoke with Nike's CEO.
It's officially the kickoff to the World Cup, at least for Nike, which doesn't sponsor the tournament like Adidas, but is going all out on products, technology, and innovation for the event and for its teams. The excitement began today when Nike unveiled a knitted football boot, or cleat, made of its signature Flyknit technology. The company calls it revolutionary.
This has been 4 years in the making. The intricacies of the design, the level of performance with the Nike Flyknit technology in this new shoe we call the Magista is actually above and beyond anything we've ever done, certainly. And I think the players have actually voted with tremendous feedback.
Adidas recently launched a similar knitted cleat for the World Cup as well. Because when it comes to capturing a global audience, for sporting consumer companies, there's nothing like the World Cup. 3.2 billion people watched the 2010 tournament in South Africa. That's 30 times the Super Bowl audience. The competition is fierce.
Innovation for the World Cup this year is more than we've ever produced for any major event, certainly in the sport of football ever. This is the Magista boot here is just the start. You'll see more innovation coming between now and the World Cup. And we think that the impact we'll have on Nike is not just in terms of football and what we do, but to reinforce our position as a leader in sport shoe and apparel innovation.
JP Morgan analysts say both Nike and Adidas should see a sales bump from the upcoming World Cup, something both companies are relying on during what's been an uncertain global economic environment, or as Parker calls it, macroeconomic volatility. And a more competitive one, too, with newer companies like Under Armour posting strong sales momentum and getting in on those high-profile sponsorships. For Nightly Business Report, I'm Sarah Eisen.
Still ahead, what are your chances that your employer will offer health benefits a decade from now? We'll take that one apart next. The The latest now on the crisis in Ukraine. In the White House press room today, President Obama said a referendum by voters in Ukraine's Crimea region to become part of Russia, scheduled to take place on March 16th, would violate international law and Ukraine's constitution.
Any discussion about the future of Ukraine must include the legitimate government of Ukraine. In 2014, we are well beyond the days when borders can be redrawn over the heads of Democratic leaders.
Meantime, the House of Representatives overwhelmingly passed a bill that would fast-track loan guarantees for Ukraine. That measure now heads to the Senate for approval, but it's unclear when the Senate will vote on it.
Some big changes are coming to retirees at Boeing. Starting in 2 years, the aerospace giant will end pension plans for all non-union workers, even its CEO and other top executives. Instead, Boeing will offer those 68,000 employees what's called a defined contribution plan, like a 401k retirement savings account. Some union workers will still receive a pension from the company.
Well, besides salaries, pensions, and savings contributions, the cost of providing health care coverage to employees is one of, if not the biggest expense for a company. And the cost keeps rising. Now, a new survey says that more larger businesses are uncertain whether they'll even offer their workers health insurance plans a decade from now. Bertha Coombs joins us now with more. Bertha, who conducted this survey, and what does it tell us about what companies' intentions are and the rising cost of health care coverage?
It talks a lot about the uncertainty in the healthcare landscape right now. It's Towers Watson, their benefits consultant, in conjunction with the National Business Group on Health. They surveyed all large employers. It's the 19th year they've done this. And 95% of them say they're very committed to providing benefits because they think that this is an important recruitment tool, particularly in some of the higher paying industries. And most of them say they think that's going to continue over the next few years. But when they ask them, what about 10 years from now? Only about a quarter of them said they thought they would still be committed to that. And that's the lowest reading they've gotten in 19 years.
But doesn't the Affordable Care Act tell these large companies that they must provide insurance options or pay a penalty?
It does. But one of the things that has a lot of large employers concerned is the Affordable Care Act. It has this thing that has been called the Cadillac tax. Basically, part of the Affordable Care Act is to try to bring costs down by getting people to use more cost-effective health care plans. So they've set this limit above $10,000, and you have to pay an excise tax of about 40% on how much richer your plans are above that $10,200 threshold.
Who pays it, the provider?
Well, it would be the employers and probably employees. So take a look at some of the industries where the plans are very rich. Healthcare. Very rich. On average, the median in 2013 was $12,800. In high tech, it was about $12,600. Those plans would be dinged for an excise tax of about $1,000 a piece. In financial services, their costs were a little bit lower. They might be paying about a $250 excise tax for each plan, and they would probably split that with their employees. So they are worried about this. This goes into effect in 2018, and that's what has employers scrambling to figure out how to bring down their costs so that they don't hit that threshold.
And a lot of us are going to be wondering, I would think, how we're going to navigate all of this. I mean, we just talked about the fact that pensions are going away, so now you have to do a defined plan or a 401k. And people have trouble navigating that. I can't even imagine navigating the healthcare exchanges.
Well, that is one of the things that people have done. They've actually worked very well in terms of the private exchanges when it comes to Medicare. A lot of retirees from companies have been doing that. But now more companies are starting to look at that sort of benefit plan when it comes to healthcare. So last year we saw Darden and Sears in particular go on the Aon Hewitt plan. And there essentially what they said was, Aon Hewitt, you handle it. And now all of the insurers on that exchange are competing for workers to select their plans. And an interesting thing has happened when they re-upped. 80% of folks were happy with their plans and kept them, but a lot of them started to shift to lower cost plans. You know those metal levels that we talk about? The platinum and the gold saw a little bit of shift down, people moving down into the bronze, into the silver, because they themselves now want to make sure that they save money.
All right, Bertha Coombs, thank you very much. Much could change over the next few years, I suppose, particularly between now and 2018 when that Cadillac tax goes into effect. Bertha Coombs, thank you. To read more about how companies are trying to navigate the new health law, head to our website, nbr.com.
Some encouraging news for men who elect to have prostate surgery soon after being diagnosed with cancer. A new study out of Sweden finds that men with early-stage prostate cancer who had their prostates surgically removed were significantly more likely to be alive nearly 2 decades later than men who did not have surgery and instead opted for so-called watchful waiting until further treatment.
Well, Disney cuts 1/4 of its workforce in its interactive division, and that's where we begin tonight's market focus. 700 jobs will be eliminated from the unit, which houses its video games and online properties. Disney Interactive has suffered more than $1 billion in losses in recent years, and the move is an effort by Disney to focus more on mobile and social games. Shares of Disney up a little bit to $83.34. And Disney's talks with DirecTV also making news today. The media giant discussing a deal with the satellite TV provider to license its shows and channels to the company as part of an internet-based TV product. This comes just a few days after Disney announced a similar carriage agreement with the Dish Network. Shares of DirecTV up about 2.5% today to $79.99. And the private equity firm Cerberus Capital Management reaching a deal, apparently, to buy the supermarket chain Safeway for more than $9 billion. Yesterday, there was a rumor that the grocery store owner Kroger wanted to make a bid for Safeway, but Cerberus has apparently scored the deal now, which was announced after the closing bell. Shares of Safeway off a bit to $39.47.
Winter weather actually helped Kroger post an earnings beat. Customers hoarded those groceries before storms, and the chain had the shelves stocked in preparation, which drove sales higher. Kroger also forecast a higher full-year profit, partly because of its acquisition of Harris Teeter, which is a local food chain. Shares still fell a little bit today, down almost 0.75% to $43.37. And Darden Restaurants cancels its annual shareholder meeting and will meet with investors one-on-one instead. This as activists have been pushing for the company to make bold moves to increase value, aside from its plan to spin off its Red Lobster chain. The company believes the small meetings will be more productive. Shares rose 2% to $48.91.
How much should you trust your stockbroker? Well, according to a Wall Street Journal analysis, more than 1,600 stockbrokers have bankruptcy filings, criminal charges, and other red flags that were not disclosed in public records and have virtually gone unnoticed by regulators, raising concerns about who has access to your money and how you should protect yourself. Joining us now to talk more about these findings is Michael Siconolfi. He's investigative editor at the Wall Street Journal. Michael, welcome. What's going on here?
Tyler, good to be with you.
What's going on?
Well, there's a pretty big problem in terms of investors' ability to be able to track what their stockbrokers' records are. And so, you know, that first off, I think most of the nation's 635,000 stockbrokers are honest, but I think that we were surprised at the number of stockbrokers who had black marks on their records that weren't reported to investors as they should have been. And it really raises a huge hole in the regulatory foundation of Wall Street and the protection for American investors.
So, Michael, what did you find through this investigation? And it was a very broad investigation. What things do not need to be reported or can easily be deleted?
Right. Well, first of all, to talk a little bit about how we got into it, we were a little frustrated at the fact that we knew that there were brokers out there with checkered pasts, and we weren't able to get adequate information from FINRA, which is the major Wall Street regulator. So we did a unique database of the records, and we found that there were a number of instances where bankruptcies, tax liens, securities fraud filings, and the like were not being reported as they should have been. Investors have the right to know about black marks in brokers' records going back 10 years, and often cases that wasn't being reported.
So who's at fault here, Michael? Is it the broker who is trying to sneakily cover up for something in their past? Is it the employer of that broker, who, as I understand it, is the ultimate party responsible for reporting that information into FINRA, which is the industry's own watchdog group?
Yeah. I think there were problems at all those levels. I think ultimately FINRA is responsible for overseeing all the brokers, but it's really been an honor system. So brokers were expected to fully report any past problems to their employers, to the brokerage firms. The brokerage firms were supposed to track that and supposed to report that to FINRA. And there were breakdowns really at all levels. And that's part of the problem because people really weren't focusing on it until we did our reporting.
So what are the do's and don'ts? You know, if you're considering entrusting your money to a broker, how do you protect yourself? What can you find out and what can't you find out?
Well, I think investors in general have to be a lot more active. I think the first thing they should do is to check with FINRA, which has a site called Broker Check, and they can look at the basic history of their brokers. I think you then have to go and do a little forensic investigating of your own and go to your state securities commissioner, for instance, and ask for information about your broker. And also just, you know, look to Google and other areas just to see if there's anything out there that you find is a potential problem. Look, there are a lot of great brokers out there, and if there are any issues you've got or any concerns you have with any past problems they've had, you really should look elsewhere.
Michael Sigonolfi, thanks very much. Michael is investigative editor at the Wall Street Journal and a heck of a softball player, too. Mike, good to see you.
Thanks, but I'll keep my day job.
All right.
Thank you.
Coming up as we continue, can entrepreneurship be taught? Well, professors at Stanford think it can, and their mission is to help develop the next big Silicon Valley tech titan.
With virtually everyone looking forward to tomorrow's February jobs report, we took a look at some Stanford University students who are enrolled in a special program teaching them how to become high-tech entrepreneurs. Josh Lipton has more on what's being learned and what those students hope to accomplish.
Instagram's founder, Kevin Systrom, sold his company to Facebook for $1 billion. As students at Stanford University now prepare for graduation, many dream of creating the next Instagram, so they do what Systrom did, enroll in the Stanford Technology Ventures Program, or STVP as it's called. The program started in 1988. Its mission is to teach students how to succeed as high-tech entrepreneurs, and its alumni have worked all over Silicon Valley, from Google to Silver Lake Partners. Every year, about 2,000 students take part in the program where they study entrepreneurship, finance, and business strategy. Many create their own business ideas, which they then present to a panel of Sand Hill Road venture capitalists, Stanford's own version of the popular television program Shark Tank.
If I want to take some of those ideas and turn them into reality, it would be very helpful to have the support of STVP and to learn how to sell my ideas to the investment community.
Professors at the school say part of the program involves toughening up these students so they can compete in the real world.
And students at this level who've gone through these multiple years of very tough selection processes are not used to being told they're wrong, okay, but that they're just perfect, okay? Well, we don't do that. We tell them that, uh-oh, you might, smell a little bit.
Professors say the students who choose to enroll in these courses are natural-born entrepreneurs. They tend to be optimists, risk-takers, and hard workers. Right after graduation, some students work for tech titans in the Valley. Others start their own companies. One success story, Skybox Imaging, which builds satellites. The company was created in this program 5 years ago and has since raised $91 million in funding. One thing is clear, after these students earn their degrees this spring, they're likely to be some of the people behind the products and companies transforming your future. Josh Lipton, Nightly Business Report, Stanford, California.
I hope my kids were watching that
Yeah, just
report.
take a class, become a gazillionaire. Love it.
Support mom and dad. That's it for Nightly Business Report for tonight. I'm Sue Herrera in for Susie Garib, and we want to remind you that this is the time of year that your public television station needs your support to make programs like this one possible.
And I'm Tyler Matheson on behalf of your public TV station. Thank you for your support. Have a good evening, everybody, and we'll hope to see you back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
I'm Tyler Matheson with a Nightly Business Report news brief. Another record-setting day on Wall Street after first-time jobless claims tumbled to a 3-month low, and corporate layoffs declined by 24% in February from last year. The Dow up 61 points. The Nasdaq ended down 5 points. The S&P 500 was higher by 3, ending at a fresh all-time closing high of 1877. With sales inside stores falling and half of its sales now made online, Staples will shut 225 outlets. Starting in 2 years, Boeing will end pension plans for all non-union workers, offering those employees 401k retirement accounts instead. Thanks to soaring home prices and the surging stock market, the Federal Reserve says household net worth rose to a record high last year to a total collective $81 trillion. And tune in to Nightly Business Report right here on your public television station.